Everyone thinks modern financial crises are unique. They're wrong. The year is 1720. London, a bustling hub of commerce, stood on the precipice of an economic experiment that would reshape its future. A company, promising untold riches from the distant Americas, began to captivate the nation's imagination, drawing in everyone from dukes to domestic servants. This was the South Sea Company, chartered in 1711. Its grand design, to consolidate Britain's national debt in exchange for exclusive trading rights in the South American colonies. Specifically, the Spanish ones, though Spain's cooperation was, at best, tentative. Britain, burdened by the War of the Spanish Succession, owed vast sums. The South Sea Company proposed a seemingly ingenious solution. Creditors could exchange their high-interest government annuities for South Sea Company stock. The appeal was instant, a chance to own a piece of a potentially lucrative venture. Initially, the company's real assets were meager. The Ciento Treaty granted them rights to supply slaves to Spanish colonies, a morally reprehensible but economically significant trade. Yet, the true value was speculative, the promise of future wealth from unexploited territories. By early 1720, the South Sea Company's stock began its meteoric ascent. From around £128 in January, it surged to over £300 by March. The directors, sensing the fever, orchestrated a masterful public relations campaign, fueling the frenzy. Parliament, swayed by the company's powerful lobbying and promises of substantial payouts, passed the South Sea Act in April. This act formalized the debt conversion scheme, giving the company an effective monopoly over the national debt. The stock price reacted predictably, skyrocketing further. The lure of quick riches became irresistible. Everyone wanted in. Nobles mortgaged estates, merchants emptied their coffers, and servants invested their life savings. The belief was widespread. The stock could only go up. This was a guaranteed path to wealth. The market became a carnival. By May, the stock hit £500. By June, it breached £800. The peak, in late June, saw shares trading at a staggering £1,050. This was pure speculation, detached from any rational assessment of the company's actual earnings or assets. This bubble, however, spawned countless others. Bubble companies emerged overnight, promising fantastic returns from absurd ventures. Perpetual motion machines, importing fat hogs from Pennsylvania, or even a company for carrying on an undertaking of great advantage, but nobody to know what it is. The South Sea Company, ironically, became concerned about these rival bubbles draining capital from their own scheme. They successfully lobbied Parliament for the Bubble Act, which outlawed unauthorized joint stock companies. The intent was to protect their monopoly, but the effect was devastating. The Bubble Act, meant to pop the small bubbles, inadvertently pricked the giant one. The public, seeing government intervention and fearing a broader collapse, began to sell. The South Sea Company's stock, having no real fundamental value to support its price, began its rapid descent. By September, the stock plummeted to £150. Investors who had bought at the peak were utterly ruined. The ensuing panic was widespread. Thousands lost everything: their homes, their livelihoods, their social standing. Suicides became common. The collapse threatened to destabilize the entire British economy and government. Sir Robert Walpole, then Paymaster General, skillfully navigated the crisis, introducing measures to restore public confidence and restructure the national debt, albeit at a severe cost. Investigations revealed widespread corruption. Directors of the South Sea Company had engaged in insider trading, bribing politicians, and even members of the royal family to ensure the passage of the South Sea Act. Many were stripped of their fortunes and imprisoned. The South Sea Bubble became a cautionary tale for generations. It demonstrated the dangers of irrational exuberance, market manipulation, and the speculative frenzy that can grip an entire nation, blinding it to fundamental economic realities. The events of 1720 fundamentally altered Britain's financial landscape. It led to stricter regulations on joint stock companies, a more cautious approach to public finance, and a lasting distrust of speculative ventures. The scars ran deep, yet the patterns persist. From the Dutch tulip mania to the dot-com bubble, history continually echoes the South Sea Company's rise and fall. The human element, greed, fear, and the herd mentality remains a constant force in financial markets. The South Sea bubble wasn't merely a financial blip. It was a profound lesson in the fragility of public trust and the volatile nature of unregulated capital. A stark reminder that even the most powerful nations are not immune to speculative madness. Understanding this 18th century debacle offers crucial insights into today's financial systems, revealing the timeless mechanisms that can lead to both immense wealth and devastating ruin. Explore how another infamous scheme, the Mississippi Bubble, unfolded in the next video.